Less new listings and plateauing inventory could put the squeeze on summer sales. It's time for a San Diego real estate market update.
Let's take a look at what's happened over the past few weeks, and then we'll zoom out to look at long-term trends. All right, here's a look at what happened between April and May.
Yes. Okay. So from April to May, new listings went down, and that's a change from last year. Pending sales are down just 0.3%. Closed sales are off 4.6%. Days on market are down 10.8%, which again, I don't necessarily expect to see this time of year, although April to May, maybe still going down. Median price is pretty much exactly the same, down by 0.1%, and homes for sale up only 7.5% from April to May.
Okay, so things have slowed down a little bit from last month, but the homes that are selling a little faster.
That's about the size of it. I guess I could have just said that.
That could have saved us all about 45 seconds there.
Yes.
Anyway, let's take a look at some long-term trends.
Okay.
So let's check out long-term trends for new listings and closed sales.
Yes. So last month I was screaming about how we're heading into a similar summer to last summer, and now things are looking a little bit different.
Summer slump.
Yeah, the summer slump is real, although it seems to be new listings are definitely slowing down sooner than they did last year. You can see they were going up still into April and May last year, and then didn't start to fall off until June or July. And here we are, new listings down April to May, closed sales down, but they were down here last summer too. So overall, though, we are seeing, like new listings peaking out up here last year, and now we're down here. And the year before that, we were over here. So we're a little slower than last summer, but not as slow as the summer before at this point with new listings. And closed sales, across, if you look at closed sales, those have stayed pretty constant over the last few summers. So it's interesting. You see closed sales staying about the same, new listings varying, and then inventory really seems to be driving what's happening with prices almost as much as rates are.
Well, it is normal to have some fluctuations even during the summer due to whatever economic conditions are going on, and we have had some weird stuff happening lately.
Well, that's no joke.
Let's check out median prices.
Okay, yeah, looking at median price, it has been really, really similar the last 3 Mays. So that's kind of the thing that's happening right now. I guess it's more of a stagnation of price increases, and now we're seeing slowing of new listings, although closed sales remaining pretty constant. So, if we start to see this inventory getting eaten up by the same level of demand, then we may see prices tick back up. But the last 3 years, things have been pretty flat with regard to pricing.
Classic high school supply and demand dynamics here.
Yeah, for sure.
I don't know if they still teach that in high school or not, but back in my day, we did.
Yeah, well, I haven't been to high school in 35 years. So,
Okay, let's check out inventory of homes for sale.
Yes. And again, looking at 2024, we were way down here. Last summer, we had a lot more inventory, and now we're down again this summer, but again, not down to as much as we were in May of 24. So looking at where we peaked out last year, it was, just around 7,000. And, right now the way things are going right now, it looks like we're not going to get to that level of inventory, because last summer things got really soft with regard to pricing. There were a lot of listings on the market and the same number of pending sales, and sellers were really scrambling to get things sold, and prices did slump 3 or 4% over last summer. But if inventory doesn't reach the levels that it did last year and pending sales continue to remain the same, then we will probably not see that same, 2, 3, 4% sagging of median price.
Well, depending on what happens with interest rates, that's going to affect, how the rest of the summer goes to a large extent.
That is true.
So let's take a look at current interest rates.
Okay.
So here are the latest Freddie Mac charts showing current interest rates.
Yes, indeed. So, the last 7-day average we have is 6.52, which is up from the week before, although, that is June 11th. So if we go back here,
and these are 30-year fixed rates.
30-year fixed rates. If we go back here to June 12th of last year, we were at 6.84. So rates are looking a little better now than they were last June anyway, which again leads me to at least sort of conjecture that we may not see the same summer slump that we did last year, because it was really very dry last summer. I mean, prices were declining and listings were stubborn. Right now we're seeing market times going down. We're seeing slightly lower interest rates than we had last summer, at least, by 0.3 something right now. But we'll see where these go, because again, like you say, a lot of weird stuff happening in the national and global economy right now, and could spell upward pressure on interest rates.
Well, we've had a couple of hot inflation reports come out lately, and those headline CPI reports are a big part of that is energy that's driving that up. If you strip away energy and just look at the core inflation, that's not quite as dramatic. So if we can get those energy costs down, oil, maybe we can drive down these interest rates and get things humming a little bit better this summer.
Yeah,
a lot of big ifs there. I'm just saying that energy is directly affecting these mortgage interest rates.
Or if we could just stop needing energy.
Well, that's probably not going to happen this summer.
Probably not.
It's more of a long-term goal.
Yeah, probably. But you're right. Yes, if oil continues to go up, then we're probably going to see higher rates, and if it softens a bit, then we might see some declines, or at least plateaus.
Well, today barrels of oil were in the 80s, where they've been higher recently. So who knows what's going to happen tomorrow? But today, oil down, 10-year treasuries down a bit. So maybe we can continue that trend.
I've heard some naysayers saying that we're going to get to 120 this summer, but right now it doesn't look that bad.
Well, we'll see. We'll have to wait and see.
We will have to wait and see. This is just all speculation.
Yes. Well, we could sit here and speculate longer, but we've probably gone on long enough.
But what does it mean for buyers and sellers? What it means for sellers right now is that less inventory and slightly lower interest rates mean most likely not as much softening of median price. So your summer sale is looking a little better probably than it was last summer. And for buyers, things are about the same. A
little more inventory, more options out there.
Slightly, but not as much as last year. Last summer was definitely a better buyer's market than at least it is right now. We'll see where we wind up toward the end of July. Because that's really when we're in what I call the summer doldrums of the San Diego real estate market. When everybody's on vacation, nobody's paying attention. That's when we really see what the summer market really is.
All right. Well, we can all look forward to that.
Indeed.
Okay. All right. Well, we hope you enjoyed this video. And if you did, please like, share, subscribe, and comment. And we'll see you next time.
Yes. And if you have any questions about buying or selling anywhere in San Diego County, send us a message or give us a call, and we'll see you right back here.